Today I want to talk about and prove how shorts are losing millions of dollars every single day, and how it's factually only a matter of time until the AMC squeeze. So stay tuned and let's make some money. Also, just a quick Moomoo update, they actually have a team of employees based in the United States, and therefore my contact has escalated my inquiry to the United States team. I'm hoping they're reviewing all AMC transactions on a line-by-line basis to determine if they ever sold any AMC order flow. Hopefully I should have an update from this US team today or over the next few days, but obviously for right now there is no Moomoo link in the description below. And now I'm going to dive straight in with the key information. So, Cold-Blooded Sheller tweeted saying, imagine being one of the biggest hedge funds in the world and you're down $42 billion on the year, losing an average of $185 million per trading day. So these hedge funds aren't just losing $1 million a day, or 5 million, or even 10 million. Some of these hedge funds are losing over $100 million every single day. The reason why these hedge funds are losing so much money is because they're so heavily over-leveraged. Even small movements in the overall market destroys their portfolio. But you may say, Tom, if they're shorting AMC, surely they're making money at the moment, which may be true. They may be making small amounts of money on their AMC shorts, but their overall portfolios are still long on the market, just like Tiger Global. Tiger Global is one of those funds losing $185 million every single day, and they're still losing it. It's because they're in these positions where they are stuck and they can't escape. These hedge funds are so heavily over-leveraged that they've taken loans against their unrecognised profits. Therefore, they're currently in negative margin territory and can't close out of their positions, otherwise they'd have to repay their loans. And these funds have also used these loans already to make new investments. Therefore, they'd have to sell off the new investments and sell off the old investments to repay those loans. And at this point, as I said, they may be in that negative margin territory where they can't even afford to pay back the loans fully. And therefore, at this point, they can't even close out of those positions. And that's why these funds continue to lose $185 million every single day, and they can't get out of it. They have to either hope the market reverses and they begin making money again, or until they hit that liquidation margin call failure point and end up being liquidated. And obviously it's not just Tiger Global that's lost $42 billion this year, down $185 million per day. There's many other hedge funds out there that are seeing the exact same losses. And this is why, while the market is continuing to fall, it's a factual guarantee that these hedge funds will be liquidated if the market falls far enough, causing the AMC squeeze. And to show how these hedge funds got into such a sticky situation and to show how heavily over-leveraged they are, I think this tweet from Dylan Leclerc explains it perfectly. He said many of these hedge funds have invested into illiquid private equity stakes that have then been bundled into a security known as a collateralized fund obligation. He says the hospital staffing company Envision Healthcare, owned by the private equity firm KKR, has the lowest possible junk credit rating and is at risk of bankruptcy. But an ownership stake in Envision, bundled with stakes in hundreds of other private equity-owned companies, has been transformed into a financial security marketed to ordinary savers and investors as a safe investment with a stellar credit rating. This is obviously the exact same thing as those collateralized debt obligations, or CDOs, from 2008, but these new ones are being called collateralized fund obligations. It says the product is known as a collateralized fund obligation, and its aim is to diversify risk by parceling up the companies providing returns. So these hedge funds have been investing into these illiquid private companies that are likely failing. They've then tried to bundle them up and sell them off. And it's likely these hedge funds have also been heavily investing into other collateralized obligations, like those single stock inverse ETFs. These hedge funds have been massively over-leveraged, investing into private equity companies and trying to bundle them up, and investing into single stock ETFs as well. This has obviously given them tons of exposure, way more exposure than they actually have capital under management, and at this point they now can't escape those positions, and they're at the mercy of the market and the mercy of all of those losses. And the reason why I say it's factually only a matter of time until these liquidations happen and the squeeze occurs is because the market is about to get a whole lot worse. And if you haven't already, be sure to join the free Discord linked in the description below. We've got 1348 indicators and we talk about AMC and share due diligence. all day long. And as I said at the start of the video, Moomoo is still investigating this payment for order flow, and therefore for right now there is no Moomoo link down in the description below. But if you do want to get some AMC related merch, be sure to check out my store, linked in the description. Right now we're seeing a number of other crypto exchanges that are about to go bankrupt over the next week or so. As BitFront tweeted, he said the Tether fraud exchange KuCoin is about to go supernova. Right now, they're paying 169% interest on their Bitcoin or 204% interest on their Tether or USDT. KuCoin is obviously desperate to get cash into their exchange so they can pay out these current withdrawals. Right now, KuCoin is obviously insolvent and can't afford to make or meet those withdrawal requests. Therefore, they're trying to do anything they can to get cash in the door, offering obscene interest rates like 169% per year or 204%. By offering such high interest rates, unknowing retail investors could potentially deposit money into KuCoin, which they're going to try and use to stay solvent. But obviously KuCoin are likely insolvent at this point and will likely go bankrupt over the next week or two unless they can convince enough unknowing investors. And it's not just KuCoin, because as Unusual tweeted, they've said the crypto exchange BitFront has just shut down. They've said BitFront said that it suspended new signups and credit card payments as of November the 28th and will suspend withdrawals on March 31st. BitFront is obviously realising they don't have enough cash to continue, and due to the massive amounts of withdrawals, they will likely be insolvent in the next few weeks, and therefore they're trying to shut down already. But again, another worrying one is Crypto.com, yet another crypto exchange. The praying mantis tweeted saying that Kronos, the coin of Crypto.com, is potentially unbacked. He said the Crypto.com reserves, or the Kronos reserves, only have $89 million sat inside, but there's over $300 million worth of Kronos that has been minted. And as I tweeted, he said Crow or Kronos is the same coin that comes from Crypto.com, the same company that was caught passing a bag of assets around before their attestations or their proof of reserves was due. You may remember from my video last week, the CEO of Crypto.com accidentally transferred $400 million to another exchange, and they then transferred it back again. This was obviously for Crypto.com to try and show they actually had proof of reserves that weren't actually theirs. And the reason why these crypto exchanges failing is so important because of all of those hedge funds out there that have invested directly into these exchanges or have invested into crypto. Many of these hedge funds are about to lose not just $185 million, but potentially $285 million per day when these exchanges start going down or continue going down and crypto continues falling. These losses that funds like Tiger Global are seeing are about to increase as crypto and the wider stock market continues to fall, especially at a faster pace. We may be seeing these hedge funds not just losing $185 million per day, but that could increase to $285 or $385 million every single day. And that's why it's only a matter of time, a factual matter of time, until these hedge funds end up going bankrupt and end up being liquidated and forced to sell off their long positions and forced to close out of their shorts. Now you may say, Tom, right now the S&P 500 is starting to run up again. Surely the bear market is over and the recession has been averted, right? Surely the stock market is just about to set new all-time highs over the next month or two, and many of these hedge funds will be absolutely fine and absolutely survive, right? Well, as Breaking Market News tweeted, he said the Fed is saying that markets right now are underpricing the risk that the FOMC meeting may be more aggressive. The market is obviously speculating that interest rate rises or interest rate increases in the next FOMC meeting will come down to 50 basis points and then to 25 basis points after that. But the Fed is basically saying, don't get ahead of your horses. We may not actually be able to drop those interest rate increases, and we may have to be more aggressive, potentially continuing to raise rates even faster. And actually in that very next sentence, the Fed then said that the Fed will need to raise interest rates even further. So right now the stock market is expecting interest rates to start falling, when in fact the Fed is saying they're going to raise rates even faster. That's obviously going to cause the wider market in the S&P 500 to do a U-turn and continue falling at an even faster rate. And that's why I've been saying we're coming into the third leg of the market crash. And that third leg will crash the market even further below 300 points for the S&P 500. That'll bring us back towards those 2020 pandemic lows, crushing the S&P 500 and crushing all of these heavily over-leveraged hedge funds. The Fed is also saying that the US economy is more vulnerable to shocks that could lead to a recession. And therefore the Fed is saying that the risk of a recession is absolutely not over, and actually the US could end up into a recession because right now it's so vulnerable. They realise that raising interest rates further will cause a recession, but they know it's something they have to do to beat inflation. And therefore they're actually not going to be decreasing rates or slowing down the increases. They're likely to continue increasing rates even faster. And now something that really ties it all together is Credit Suisse. I want to explain how Credit Suisse ties together the wider market and these meme stocks like AMC, Ape and GameStop. As Jan-Jack tweeted, he said the Credit Suisse 5-year credit default swaps have reached an all-time high at 398 basis points. Now that basically means that it's getting even more expensive for these hedge funds to pay their insurance premium against the risk of Credit Suisse defaulting on its debt. Now the reason why Credit Suisse is more likely to default on their debt is because their risk of default is linked to the loans that Credit Suisse has given out. Now Credit Suisse has given out these risky loans to risky hedge funds and family offices that are invested in risky assets like fail to delivers, like swaps and like those other hidden investments or those other hidden short positions. Many of these funds obviously have these heavily over-leveraged positions that they can't escape from, and they've taken their loans, like I said earlier, they've taken loans out against these risky positions to invest in even more risky positions, and they've taken out those loans from Credit Suisse. And obviously the market recognises that Credit Suisse is also likely to default because they can't recall their loans that they've given to these risky hedge funds because these risky hedge funds can't escape their positions. Therefore, Credit Suisse won't be receiving the money back that they've lent out because these hedge funds are going to go bankrupt, and therefore Credit Suisse itself will go bankrupt as well. And therefore you can basically relate the price of these Credit Suisse credit default swaps to the likelihood and the closeness of the squeeze occurring. As these credit default swap prices continue to increase past 398 basis points, it basically means the squeeze is getting even closer. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.